Welcome everyone to another episode of Financial 15. Kevin and I have lots of great information today, talking about 5 essentials you need to know before investing. We're also going to share a few stories that we've gone through in the investment world. Lots of great information. You definitely want to stick around.
Yeah, when you talk investing, a lot of people have a lot of different ideas as to how it works. We just want to make sure that you're covered with how the essentials work, what you should really be looking at when you're dealing with investing. Now, if you want to get more of our Financial 15s or anything else on our scenario, go to our YouTube channel, please, and subscribe. That's one of the best places to go. You can easily see it. Subscribe down below. Click on the buttons. It'll make it easy. Also, if you want, like us on Facebook, or most importantly, please visit our website at beckerorr.com. You'll have all our videos. You'll have all our blogs. You'll have everything else we need for our events coming up. Lots of information for you to deal with. Now, today we want to talk about the 5 essentials that you should know before investing. A lot of people just want to say, hey, I'm going to put the money in and you let it go from there. No, that's not the way it works. There are essential things you should look at. Clint, what do we start with on our 5 essentials?
We've got a couple of them here we're going to dive in, and this is partly through our experience in dealing with clients in the markets, also partly just from personal experience of having been investors and made mistakes along the way. 5 things we think people should think about before actually putting money in the market. One is clearly an understanding of risk, right? A lot of people define risk in different ways. Risk can be volatility, the market goes up and down. Risk can be the fact you don't achieve your goals. But having a good understanding of risk in all of its aspects is important before you actually start investing. In a key one, many people invest in the stock market. And Kevin, if you invest in stocks, unfortunately, part of the deal is the market doesn't go up in a straight line. There's going to be volatility.
Yeah, and that's a big factor. I mean, a lot of people say, well, I can handle risk and yeah, there's not a problem until they actually see what risk is. I mean, a lot of people, the pandemic came, 3-week period, 40% drop. They couldn't handle risk. And they'd always said, oh, yeah, I can deal with it. It's a short-term sort of scenario, which is exactly what it is. But you have to know what your risk factors are, whether it's a short-term scenario, whether it's long-term risk, whatever the case may be. As Clint mentioned, in the stock market, there's going to be volatility. There's going to be things that disrupt the market one way or another. Can you handle it on a daily basis? Can you handle it on a monthly, a yearly basis? It's very important that you understand, A, what risk is, and B, what your risk level is. That's the most important aspect to look at.
And generally, my experience, people overestimate their risk tolerance. We'll talk about why in just a moment. But when things are going up, everybody's high risk. We all want to make lots of money. The second things start going down, everybody's conservative. So keep that in mind. We tend to overestimate the risk tolerance until we actually have to endure the volatility. And again, coming down to how you define risk, we talked about volatility if you own stocks, but in general, risk can also be defined as not achieving your goals, right? If you're investing with a purpose, investing because I want to retire, investing because I want to save up to buy a house, whatever the goal is, not meeting that mark is also a form of risk, right? So we have to keep that in mind, and that's going to help impact or guide our actions. Maybe the actions I want to pull out of the market, or I want to go really low risk, or whatever it is. We got to make sure, is that action going to impact the ability for us to achieve our goal? Because it's a different form of risk. So understanding a risk, the first essential, talk about volatility, risk tolerance, also the risk of not achieving our goals. The second essential here, Kevin, and this is a big one and one very difficult to actually achieve, but removing emotions from the investing decisions.
Yeah, I mean, it's gotten worse as we've gotten on in years. And I think the main reason is because you go back 30 years ago, I mean, the main source of news for anything that would have been stock market oriented would have been, you found out at the end of the day when the news came on, whether the market went up or down. You didn't know what happened during the day. Nowadays, with 24/7 news everywhere, you know instantaneously if things are going up, or if they're going down, and your emotions kick in. So if all of a sudden a pandemic hits, things start to drop really quick over the course of the week, you know about it instantly, as opposed to once a month on the statement, you panic and you want to get out. Removing this emotion is the big thing. Going in, as we said, understanding your risk. If you know what the risks are, then you have a little bit more chance of removing some of those emotions. It's never easy when you see the things drop, and it's not fear or panic. Going up, most people never have a problem. Oh, I can handle it. It'll go up and go up. But when you start to see things fall, emotions kick in really quick, and people tend to overreact, as opposed to, let me think about this. It may not be rational, but I got to get out because I'm losing everything. So those are things that you have to start to get into control to be able to more understand how to invest essentially.
Yeah, and you're right. It has changed over years. Like these didn't exist in
No.
1987, right? You had a big crash in 87. It just boggles the mind, the fact in 87 you had a massive crash. People didn't know until the end of the day, unless you were a
Yep.
trader. So the average person that didn't know they had this massive drop until the news at the end of the day. Now it happens and you get 17 updates on your phone the second the market starts to move. So removing the emotions, in my mind, more difficult now because we're constantly
Very.
inundated with all these little details. And a personal story, fear and greed are the big emotions. Greed on the way up, fear on the way down.
Yep.
I was 18. I signed up for a newsletter service back when they actually mailed letters. And there was penny stock tips. Like they're going to give me these penny stocks. They're going to go to the moon. I was going to just like be instantly rich. The greed took over, and I just lost a bunch of money is what happened. None of those penny stocks worked out. But again, removing the emotions, very difficult. A quick tip on how to achieve that, in my mind, comes down to properly setting expectations, right? Again, before you invest. If you're going to invest and there's going to be stocks, well, we know stocks are volatile. There's periods that go up, periods that go down. If you set that expectation in advance, helps to manage the emotions a little better. And also knowing yourself, right? I could just mention that greed took over when I was younger and I tried to do those penny stocks, learned my lesson. But now when things go up, I know I'll have that emotional reaction. I'm expecting it, right? Not that you don't have the reaction, but if you have the expectation, easier to manage it. So those expectations are key. Move on to essential number 3 here, Kevin. And this is, I'd say, a big one now, just because of all the headlines. But the headlines, the news, the politics, important when we go to vote. Are they important, though, in terms of investing?
Yeah, that's another one. I mean, as we mentioned beforehand, politics and news, they are very much in your face right now. It's not that you're waiting for Walter Cronkite at the end of the day to tell you what went on. You're getting instantaneously. The minute something happens, Mar-a-Lago's attacked, bingo. All of a sudden the news is out there and everybody's going to say what's going on. But at the end of the day, most of these effects have limited impact on the market. It may react for a day or two. It may have no reaction whatsoever. But over the planned time, news that you get, all the stuff that comes out from Jackson Hole, from Powell and all this, depending on what your goal scenario is, it's going to have limited to no impact. We've seen beforehand, and we've done it in financial 15s before, where we've seen, doesn't matter who's in power, things happen, markets don't react to it overall in a longer period of time. So remember, realistic goal, depending on whether it's short-term or long-term that you're dealing with, most of this stuff is going to have minimal impact. It's just a flashpoint in time, and then it's forgotten about, usually by the next day or 2 days down the road.
Yeah, generally the market doesn't care about politics. I mean, important if you're going to be voting, but politics best left at the door when it comes to investing. So that's an essential to keep in mind before you invest. Number 4 here, don't change your plan because of volatility. Now, this, of course, assumes you have a financial plan or you have an investment plan, which is a different key. But the idea is when the volatility hits, and you can see this is relating back to our prior topics about expectations, removing emotions, they're all kind of coming together here. But you don't want to change mid-course because of the turbulence.
Yeah, and as we mentioned beforehand, where it sits there, I mean, if it's a longer term plan, you're looking 5, 10, 15 years down the road, things that are happening today will have very little impact to where they're going to be 5 years down the road. Yeah. It's going to be very minimal. So changing because you've had a very big drop, or all of a sudden the inflation marks come around, or the interest rates have gone up, it's not really going to affect it down that road. If it is a short-term investment, you're looking 6 months down the road, chances are if you set your plan right on risk, volatility won't matter because you're very much into something that's probably a lot more conservative in nature. So again, making sure that you don't change your plan because of the volatility is the big factor, because too many people, they sit there and they see what it is and, oh, okay, well, all of a sudden I've gone from a long-term investor to a short-term investor. I got to put everything in GICs so that I can meet my goal. Well, that may not happen if you change course in the middle because of the small amount of recent volatility that's gone on.
Yeah, and part of that, some tips to help achieve that, to accomplish that goal, is ensuring you have clear objectives, right? Remember why it is we invest in the first place. Is the goal just to make money? Usually that's not the case. Usually it's a specific purpose. I'm investing to save money for a house. I want to buy in 2 years. I'm investing for retirement. Whatever the goal is, if you understand the clear objective, it's easier to have some perspective with the current volatility, easier to stick to that financial plan, right? So ensuring you have those goals in mind helps put some perspective and helps stick to that plan. And connected to that is time frame, right? Understanding the time frame connected to your goal. If the goal is to buy a house in 2 years, well, you probably wouldn't be in the stock market anyway. That's too short of a time period to be in the market. So the likelihood of seeing some volatility in that time frame is very low. But again, you do that up front. You do that planning up front. You understand the goal, you understand the time frame, and then you invest accordingly, and you have your expectations set and in mind. But part of this, and this is difficult because we don't live in the long term, we live today, we live in the
No.
now, which is hard to comprehend. But the long term being retirement is often longer than people think. Usually when you hit retirement, it still takes a couple of decades. You're normally retired for a good 20 plus years. And then the idea, you might not spend all the money, so part of it could actually be part of your estate, which now includes the next generation. So you have an even longer time frame. So getting a good concept of really just what is that time frame is also crucial.
Yeah, and I mean that's a big factor, as you mentioned, on long term. I mean, too many people think, well, I got to invest now for retirement, and then when I hit retirement, I don't have to invest anymore because that's what I use it for. Well, no. You're investing into retirement as well, as you mentioned. If it's another 20 years, well, okay, your objectives don't have to necessarily change at 65 if you're going to live to 85. So you've got to counteract for all that. So understanding long term is a huge factor, especially if that's what your investment goals are. And that leads us all to the fact that the Becker and Orr broken record comes over and over again. What should you be doing? You should have a plan. This is a key ingredient for everyone. Just putting money into the market and hoping and praying, it's like going to Vegas and putting it down on red or black. Have a plan when you're going to invest. Is the investment for a short-term scenario, as Clint mentioned, like buying a house? Is it for longer term, for your retirement? Are you putting money away so that you can secure something for a special donation if you pass in your estate? Are you looking for it for RESPs for the kids? Having a plan is essential. That will allow you to control a lot of the other ones in dealing with risk and volatility and everything else. But as I say, we may mention it over and over again, but there's a rationale for it. It's a very important piece of anything to do with your financial plan and your investing portfolio.
Yeah, and we're talking financial plan here, these larger financial objectives. Some folks just want to invest and they want to be traders, but even then, it's key to have an investing plan, right? If you're going to be a trader, you know before you enter any order, all right, when am I going to get out of this stock? How long do I intend to hold it for? So you have some parameters set. So if you just zoom in on the investment part, there is an investment plan to guide that as well, which helps control all the other essentials we just talked about. So those plans are certainly key. And if you need help with your plan, or if you have questions about the market, really anything in the financial world, we'd be happy to help out. You can see it on the bottom of the screen there, chatwithclintonkevin.com. It's part of the website. You fill it in and you hit the submit button. We'd love to hear from you, love to help out. So please visit chatwithclintonkevin.com. Any parting comments for the folks, Kevin?
No, you summed it up beautifully. I think we're good till the next time we get on the air.
That works. Stay safe, everyone. Take care.